Hey everybody, welcome back to the channel. We have seen big tech go crazy over the past couple weeks with earnings. Google popped up, Facebook went down. Facebook lost $250 billion in market cap. Google went from around 2,700 down to 3,000. Now Google is back down a little bit, but Google at least did not lose $250 billion in market cap because that would have been a little bit crazy. Chamath Palihapitiya is a billionaire. He is on the All In podcast. He owns the Warriors, does a lot of SPAC deals. You can say a lot of stuff about him, good or bad. He called this trade a couple of weeks ago, or I think a month ago, and we're going to analyze today how he called this trade and what his logic was for going long Google and short companies like Facebook. Now, disclosure, I am long Facebook. I have about 10 shares of Facebook at an average around 330, so I'm down $1,000 right now. I bought it before earnings because I thought Facebook was incredibly undervalued, and if I thought Facebook was undervalued then, you must know how I feel about Facebook being undervalued now. However, my conviction with Facebook has been struggling a bit. I'm not selling my position, and in fact, I'm getting ready to buy the dip, but I'm trying to understand a lot more about why I think Facebook has potential upside. When you listen to someone like Chamath talk, he definitely challenges your conviction a lot in terms of the logic that he comes up with for Facebook. So I'll do a video in the future on how I'm thinking about Facebook and my overall thoughts. But in this video, we're going to analyze what the logic is for what he calls is the greatest spread trade of his life, to be long one stock and short the other. And that's kind of the nature of a spread trade. And in this case, he's going long Google, which means he's betting Google is going to work, Google's going to win, Google's going to be the stock that appreciates in value when it comes to big tech, and Facebook is not going to be a winner when it comes to the next 5-6 years. Let's get into it.
I think that the Google long Netflix short play is the right play.
I think the best trade on the internet, the most obvious, simple money making trade is long Microsoft, Google, short big tech, short the rest of big tech.
Short IBM, short Netflix.
No. Meaning you can very comfortably short Apple, Facebook, Amazon, Netflix, and be long Microsoft, Google. So as a spread trade,
right.
It's the best risk parity trade on the internet right now. I mean, period, in the markets.
Can you explain a spread trade?
So look, I tweeted this a while ago, but it's like, and again, I think like, well, let me be constructive and say the people on Twitter that respond to these threads are not totally stupid, although I think they're kind of idiotic. I said, here's how you can effectively, I said something about, big tech, and I said, I can comfortably put my short on. And I'm kind of trolling people when I do that because I'm not telling them the full trade. And the real trade, whenever you put anything on, in my opinion, is all about managing risk. And the best thing about the internet and the stock market is that, when you're betting on internet stocks, you don't necessarily have to be naked long or naked short, which comes with a lot more risk than if you were long one security and short another against it. So for example, over the last 10 years, you would have made a lot of money by being long Amazon and short a basket of traditional commerce companies, offline commerce. I'm going to make up a basket, but Macy's, JCPenney, Kmart, Sears, right? So if you were short those and long Amazon, that's what's called a spread trade. You're basically playing the gap between your longs and your shorts.
It's independent of where the market generally trades. It's one of the key
irrelevant
points
of the market.
Right.
You're basically
because
saying
those stocks could go up, but just not
everything
anywhere
could go,
near
right.
Amazon.
Yeah.
When you put that trade on, for example, it's I'm going to bet that if everything goes up, Amazon will go up more than Kmart, Walmart, Sears. And if the stock market goes down, Amazon won't go down that much, but these ones will go down a lot.
So it's important to analyze what a spread trade is right there. And I didn't even really know what a spread trade was until I watched this podcast and I started to understand a lot more about it. But it's this idea that you're making a dualistic bet. A bet that if I'm going long Amazon, that means I think the future of retail is going to be on the internet. It's not going to be in stores and malls, which means I'm going short, and shorting a stock means you make upside money if the stock actually reaches the downside, right? So if the stock price goes down, you make more money. Basically thinking all the regular stores that are engaging in commerce right now are not going to be able to compete with Amazon, or they're not going to be good, which means if they go down, I make money. If Amazon goes up, which inversely should happen if they go down, because that's where people are going to be buying stuff from, which means Amazon's going to get that value, then I also make money because I'm long Amazon. But it also means that even if all those stocks go up, Amazon, like those stocks like Kmart, Sears, they're not going to go up at the level of an Amazon, which is what the spread trade allows you to gain upside in. And if all these stocks go down, like if people just stop buying stuff, Amazon's not going to be affected as much as those stocks because people are still going to be using Amazon more. So in this context, Chamath is talking about what the spread trade could be like when it comes to his logic for going long Google and shorting Facebook.
And you're playing the spread. So just to be very explicit, there was and I talked about this last week, but this idea wasn't mine. It's a borrowed trade from somebody who's a very well-known hedge fund manager who put it on in massive size. And, to be honest, not knowing much of anything, I just copied it. But his initial trade was long Google, short Facebook. And that trade basically was at parity, which meant that the long and the short canceled each other out for about the last 4 years. Until the last year, it completely blew out and it returned about 85%. So if you had put $100 in, you would have made about 85 bucks on this trade by being long Google, short Facebook. The bigger trade at scale is actually long Google and Microsoft and short the rest of big tech. And there's a lot of vagaries why that this idea makes a lot of sense. But
what you're saying is they'll outperform the other basket of tech
on a relative basis.
On a relative basis. So it's not like you're saying Airbnb can't go up or Facebook can't go up. It could. It's not going to go as much as those other two.
He's saying that the $1 trillion market cap companies, not the Airbnbs.
Oh, okay.
And the reason why focusing there makes sense is they're hyper liquid markets. They have tremendous ways in which you can have massive size on. So you could put a trade of 10 billion long versus 10 billion short. I mean, you can put mega size on these things if you have real conviction. And then the third thing is when the banks look at that kind of position, they actually, from a risk management perspective, treat it differently than if you were just naked long any one of these things. Or
naked long would be just making one bet.
Yeah, or naked short, which is even more dangerous. So
because if the market collapses by 30%, both stocks might go down 30 roughly, but one will go down 32 and the other one will go down 28. And so you're only
down
2% as opposed to the 30%. So all the market risk is taken out when you make trades like that.
This is actually really interesting, and that's kind of what Chamath was talking about, which is that, and the reason it's interesting because we just saw the market crash, right? Where a lot of these stocks lost a lot of their initial value. Now, big tech held up a decent amount of the market because big tech is big tech, and a lot of big tech is in the NASDAQ and S&P and all that stuff, right? So like, those were the stocks that were the last to kind of go down, and earnings was going to dictate if the market was going to demolish them. So with Amazon, earnings was good. Amazon's shot up. Facebook, earnings were bad. The market destroyed Facebook. But if you were long short Facebook, 30%, 28%, you would only lose 2% based upon what's happening, not a full 30 or 28 if you're naked long or naked short, just one of those stocks.
Yeah.
The reason it's possible also today to do so at such a scale, right, Chamath, is interest rates are so low. So when you borrow on margin to go long, the rate is very low. And when you short the stock, if it's a highly liquid stock, it doesn't cost a lot to borrow to short.
That's right.
So your actual, carrying cost on that trade ends up being pretty low relative to the upside you expect.
So just to give you a sense of it, my, when I tweeted that tweet out, to complete the picture, I was actually long something against my proposed short. And I put it on in pretty meaningful leverage. And it's worked out really well because I was playing the spread. I was basically betting that the safest company on the internet today is Google because they're both a platform company. And to the extent that they're at risk at being an app company, the risk is to Apple. But because they pay Apple so much for search, they're inoculated. And
what Chamath is talking about here, and this is what I really wanted to get into, is now he's going to be describing why Google is so valuable and one of the best stocks to bet on the internet. Now, I'm not long Google. I might enter a position soon, especially because they're going to do a split and it hit 3K on the news of the 21 split, and now it's just back down. So like the momentum of that split wasn't enough to maintain the stock. But there are some like concerns around how much more Google could grow. The reason I bet Facebook over Google is because Facebook was a $900 billion company. Google was a $2 trillion or 1 point something trillion. And I was like, I think it's easier for Facebook to double in the next 5 years and become a $2 trillion company versus Google to double and become like a $3.8 trillion company, right? That was my initial logic behind it. It wasn't anything against Google. Like I love Google. I love YouTube. I think there's a lot of potential there. Obviously, the entire world uses it. They control the traffic of the internet. But I just saw from a growth potential, Facebook had more upside. Obviously, we saw what happened, right? So we'll see what happens in the future. His argument here is that Google is a platform. It's not an app company. And if they were an app, that means they would be relegated to Apple, right? Because if they were an app, then that means that the iOS would control their destiny. But the default search browser on any phone is Google. Why? Because if it's Android, it's definitely Google. And if it's Apple, it's Safari. What's in Safari? Search being Google. Now, it would have been really interesting if Apple, when they made the iPhone in 2007, created their own search engine and had a focus on user privacy. I think, to be honest, that is one of Apple's biggest mistakes. Because think about it. If Apple had made their own search engine in 2007, it's not that hard to create a search engine. It's really just about first mover advantage. You get a bunch of content, you put it in one place, you search it, you create some crawling algorithms. Google had the best one in 1999, but like Apple would have been able to figure it out. It wouldn't have been that crazy. And they have the brand to be able to go against Google. And if their business model didn't rely on selling ads, which they don't really need to sell ads, they sell product, then like they have a direct ability to subsidize all the costs of the search engine because they don't need advertising to be able to fund it. At that point, they could have made their own search engine. Now, no one knew how big the iPhone would be in 2007, but now the entire world is using the iPhone, right? Obviously there's competitors, but like the iPhone is big. Like everything is sort of built in optimization for the iPhone, which means you would have had hundreds of millions of people having a search engine right on their phone that's built by Apple. Apple would have controlled where you search and how you get your information. Google wouldn't have controlled that. The reason Google is so powerful is because the world shifted to iPhone versus desktop from 2007 to 2013. And Google was the default browser, which means Google got all of that traffic. And Google pays something like $18 billion a year to Apple to make sure that relationship exists. Now, the reason I think Apple did this in 2007 is because they wanted to focus on product, not like the search, and they wanted to provide the best experience. Google obviously is the best search experience in the world, so they integrated that easily. But if they did that, that would have been kind of crazy. As a result, this allowed Google to maintain a relationship with Apple that is fundamentally different than Facebook's relationship. Facebook is just an app on the App Store. It is subject to all these changes. Google is a search engine and partner with Apple. And in and of itself, you're going to treat your partners better than the people that are just using your App Store, especially when those partners are giving you $15 billion a year. It's just inevitable. So at that point, and that's a point David Sachs actually made in an upcoming podcast, which was just, who's another member of the All In podcast, which is just like, look, you're going to treat people better if they're giving you a lot of money. So at that point, Google is not as susceptible to the same problems Facebook is susceptible towards, which gives it an edge in terms of being one of the most valuable internet companies.
So in any event, the trade is what the trade is. The bigger thing is what is going on at Facebook. And I think what you see are three really important headwinds that Facebook called out explicitly. One is that when they talked about usage kind of flattening and starting to decay, what they're really talking about is TikTok. And I think what we learned is that TikTok is an enormous threat and a huge competitive force now in the consumer social app ecosystem. The second is that Facebook is fundamentally an app that sits inside of an ecosystem that is subject to the rules of the platform owner, and that's Apple and Google. And so this IDFA change, so the change in how you can track advertisers, Facebook said is going to have a $10 billion impact in 2022. And then the third thing, which was more implicit, is in order for them to grow, if you can't grow organically, the only other way to grow is inorganically. And unfortunately, as we're seeing, the regulatory focus on this company is really enormous.
All right, so those are the three arguments I wanted to talk about for why Facebook is actually susceptible to a lot of problems. This is sort of the bear case for going long Google, short Facebook, which Chamath called correctly in the spread trade, ended up being very, very correct. The whole concept is Facebook has three main problems. Those problems are number one, TikTok. TikTok's a big force, a lot of attention, short form video. That short form video is happening on TikTok more than it is happening on Facebook. They tried to implement Instagram and Reels, and Facebook even has Reels. And will that work? We'll see if it takes attention away from TikTok. But from my own experience with using TikTok and Reels, Reels has no comparison to TikTok. Like when you use a network built for a certain type of content versus a type of content on a network not built for that, it's not the same. YouTube Shorts sucks on YouTube. It just does. And TikTok doesn't. And the same TikToks that are posted on YouTube Shorts get like literally 1/1000th of the views. I saw a TikTok that had like 750,000, and on YouTube it had like 17 views. I was like, what is going on? So it's like, it's not a question of quality of content. It's a question of how the algorithm is distributing it. And on TikTok, you're just getting way more distribution than you're getting on some of these other platforms. So that's one thing. And that means that Instagram creators are probably going to not use Instagram as much if they're getting more reach on TikTok. Number two is this entire idea behind the IDFA changes, right? So if Facebook's just an app in Apple's ecosystem, Apple can turn the light switch on and off. And we already talked about how they don't turn the light switch on and off for Google because Google pays them $10 billion a year for search. So they're less likely to screw them over. So when it comes to that respect, if Apple wants to, screw Facebook over, and Tim Cook really doesn't like Facebook because he cares about user privacy and Facebook does generally does not care that much about user privacy, they care more about data, then that's not an app that's going to get a lot of respect on the iPhone platform or the iOS platform, which is why it's subject to Apple. That's why Facebook's trying to build their own metaverse, because if they can own the hardware and software of their own ecosystem, they don't have to deal with Apple. Will that happen? We'll see, but that's the problem. Number 3 is this idea of regulatory problems. Facebook actually might finally be able to buy another company because their market cap now is below all of their competitors. I mean, they're at $600 billion. All their competitors are multi-trillion dollar companies. So it's like you cannot say meaningfully in a court of law that Facebook is this monopoly. Like, it's not. Even digital advertising, Amazon made $30 billion last year on digital ads. Facebook's entire business model is ads. That $30 billion is like a little bit of Amazon's overall portfolio when it comes to how they make revenue. So like, you cannot say that Facebook is a monopoly, which means this massive drop in stock price might actually be the best thing for Facebook in terms of them being able to acquire the next Instagram or WhatsApp to actually be able to grow, because they can't grow organically because they already have 37% of the population using their platform. So it's a really, really interesting thing to ultimately think about, and it gives you an idea for how, if the regulatory burdens are still bad and regulators are not going to let them buy a new app, even though their market cap is crushed, TikTok is a big problem, and they are left with an Apple's iOS changes and iOS's ecosystem, then where is the opportunity to Facebook to grow in relationship to Google, something that is YouTube that's not going away? Like, YouTube is an absolute monster, and like the world's video is consumed on YouTube. And they have search. At the end of the day, they have search. People don't go to Facebook to search. They go to connect with their friends and family. I can tell you, as someone who doesn't use Facebook anymore, I don't care that much about my friends and family anymore on Facebook, right? There's like other things that I care about in terms of consuming content. But search, I care about searching like 17,000 things a day because I'm curious about stuff every single day. Like yesterday, I searched what's the population of Lagos, Nigeria, because I watched a video on it, right? Like just random stuff that pops into my head. You go and you search, and in that relationship, there is a opportunity for Google to massively grow. There's also 3 billion people that aren't online on the internet yet. When they come online, they're gonna either have a Facebook account or they're gonna use Google search. I think because Android's phones are gonna be more likely in those areas that are less developed, because those phones are more cheaper than iPhones, they're gonna have access to Google and YouTube way quicker before they have access to Facebook. Facebook, you need a bunch of people in a community to join for you to have value out of it. YouTube, you get content. Google, you get results. So like, it makes a lot of sense why one would go long Google and short Facebook. And I think Chamath, he gets some things wrong, gets some things right. There's a lot of stuff you could say about him, but on this one, he was absolutely correct. In November, I think he called this, or December, he probably made a lot of money on this spread trade, ultimately coming correct in the past couple months, or in the past couple weeks. So let me know what you guys think. Are you long Google, short Facebook? What are your thoughts on spread trades? How do you think about trading two stocks against each other? And ultimately, what do you think about Chamath's thoughts on Facebook and its headwinds going in the future? Thank you guys for watching so much. My name is Amit. Looking forward to reading the comments. I'll see you in the next one.